Imagine this, you're ready to start your dream business. You've got the perfect idea, a solid plan, and that fire in your belly to make it big. But then, someone asks, what's your cost of capital? Your mind goes blank. Sounds technical, right? But here's the deal, if you don't understand your cost of capital, you're essentially gambling with your future wealth. It's like driving blindfolded on a highway. If you had to choose between borrowing from your strict dad or a super friendly banker, who would you pick? Well, spoiler alert, they're both going to charge you interest, just in different ways. In this video, we're going to unpack the cost of capital, what it is, why it matters, and how it's the cornerstone of every financial decision. Stick around because, by the end of this video, you'll not only understand the concept but also know how to leverage it to build wealth and make smarter financial moves. And trust me, the insights you'll gain could save you from making expensive mistakes. What is the cost of capital? Let's simplify. The cost of capital is the price you pay for using someone else's money. Whether you're borrowing from a bank, selling shares, or using your savings, there's always a cost involved. It's like paying a toll to access a faster route to success. Think of it this way, you want to buy a car. You have two options, 1, get a loan with interest, or 2, use your savings and miss out on the returns you could have earned by investing that money. Both options have a cost. That cost is your cost of capital. But why is this cost so critical? Because it's the invisible hand that dictates whether your investments, business decisions, or even personal financial goals will pay off. Let's dive deeper. Types of cost of capital. 1. Debt capital. This is the money you borrow. Think bank loans or bonds. The cost? Interest rates. 2. Equity capital. This is money you raise by giving up ownership, like selling shares. The cost? Shareholders expect returns. 3. Opportunity cost. Using your own money has a hidden cost, what you could have earned elsewhere. Here's the kicker, not all capital costs are created equal. What if I told you that the cheapest option could sometimes be the riskiest? We'll explore this shortly. Why does cost of capital matter? Imagine a startup founder trying to decide between taking a loan or giving up equity to investors. If the founder doesn't calculate their cost of capital accurately, they could end up overpaying or diluting their ownership unnecessarily. Knowing the cost of capital helps you make decisions that align with your long-term goals. Every financial choice you make, whether it's investing, saving, or borrowing, has an underlying cost of capital. Ignoring it is like ignoring the interest rate on your credit card. Dangerous, right? Coming up next, we'll break down the formula to calculate your cost of capital and show you how to apply it to real-world scenarios. How to calculate cost of capital. Calculating the cost of capital involves understanding the weighted average cost of capital WACC. Sounds intimidating? Don't worry, we'll break it down. 1. Cost of debt. Take the interest rate and adjust it for taxes. For example, if the interest rate is 10% and your tax rate is 30%, the after-tax cost is 7%. 2. Cost of equity. Use the capital asset pricing model CAP, which factors in risk and expected returns. 3. WACC formula. Combine the costs of debt and equity, weighted by how much of each you use. CAP might sound like the name of a rock band, but trust me, it's more about numbers than guitars. Why cost of capital varies. A startup's cost of capital is often sky-high because it's risky. An established company, like Reliance, enjoys lower costs due to trust and stability. So, how do you reduce your cost of capital without compromising growth? That's where strategy comes into play. Factors that influence cost of capital. 1. Market conditions, interest rates, inflation, and economic trends play a significant role. 2. Business risk. Higher risk means higher cost of equity. 3. Tax benefits. Debt can be cheaper because of tax deductibility. Now that we understand the factors, let's explore practical strategies to optimize your cost of capital. Strategies to optimize cost of capital. Here's the exciting part. You can control your cost of capital. Yes, it's not just a number, it's a lever you can pull to shape your financial future. 1. Diversify funding sources. Don't rely solely on debt or equity. Balance is key. 2. Improve creditworthiness. Better credit scores mean lower interest rates. 3. Enhance business stability. Stability attracts cheaper equity capital. 4. Leverage tax benefits. Interest on debt is tax deductible, reducing your effective cost. Ever wondered why billion-dollar companies still take loans? Because debt, when managed well, is cheaper than equity. Surprised? Cost of capital in personal finance. Even in personal finance, the concept applies. Should you use a credit card or dip into your savings? Knowing your personal cost of capital helps you decide. Here's a question to ponder: what if the secret to building wealth isn't just about earning more but mastering the art of minimizing your cost of capital? Meet Arjun, a 28-year-old entrepreneur. Arjun used his understanding of cost of capital to raise funds strategically. By diversifying his funding sources and improving his creditworthiness, he managed to reduce his WACC and scale his business efficiently. Today, Arjun's company is valued at over 50 crores. How did he do it? It all started with understanding his cost of capital. Understanding the cost of capital is like unlocking a new level in the game of wealth building. It's not just for businesses or finance pros, it's for anyone who dreams of financial freedom. In our upcoming video, we'll uncover real-life examples of how businesses and individuals have mastered this concept to create massive wealth. You won't want to miss it.